Yolo. Today we're going to be taking a look at 5 different stocks and seeing how much monthly dividend income we could generate with a $10,000 theoretical investment into each one. We'll be ranking them from number 5 to number 1, from lowest paying dividends to highest paying dividends. And as always, this is not financial advice. I'm not a financial advisor or a fiduciary. Do your own due diligence. This is for entertainment and educational purposes. Now that we got that out of the way, let's get into it. Starting off with number 5, we have Apple Hospitality REIT. Ticker symbol APLE. Now, I know it might sound a little confusing, but it has nothing to do with the actual Apple company that does iPhones. This is something entirely different. Now, what they do is they own and operate hotels, basically. Most hotel chains. Think hotels like Hilton, Marriott, and Hyatt. Anytime you see those hotels, they belong to Apple Hospitality REIT. Now, they take the money from the hotels and they pay it to their investors in the form of dividends. They pay out 8 cents per share, paid out monthly. And their current share price is sitting at about $12.51. So $10,000 invested in them at $12.51 a share comes out to roughly 799 shares. Now we take that and we multiply it by the 8 cents a month, and that comes out to a monthly income of $63.95 with a little bit of rounding. Now that doesn't sound like a whole lot, but this is the stock in 5th place today. It pays the lowest amount per share. So as we continue, it'll only get better from here. Now we move on to the stock in number 4 list today. Ticker symbol PFLT. PennantPark Floating Rate Capital. Now they are a BDC, a business development company, and they specialize in senior secured floating rate loans for middle market U.S. company. Pretty much the medium run-of-the-mill businesses. They stay away from startups which are higher risk and potentially higher reward to lower the chance of getting defaults on the loans or giving money to someone who won't pay it back. Now, focusing on the middle run companies generates them more steady, reliable payments and less volatility. But with less risk comes less reward. So when it comes to BDCs, they don't make as much as they theoretically could be or as other BDCs do, because they try to trade off income for risk and keep a healthy balance between the two. They pay a dividend of 10.25 or 10 and a quarter cents, and they're currently sitting at about $8.47 per share. So our $10,000 would get us about 1,180 shares. Now we multiply that by our 10.25 or 10 and a quarter cents per share dividend, and that would be a payment of about $121.02 with a little bit of rounding each month. Now we move on to the next stock on our list. Ticker symbol HRZN, Horizon Technology Finance. They are another BDC, business development company, but they particularly focus on early stage or high growth tech and life science companies, which is another way of saying high risk, high reward, because that's basically startups. And as we all know, startups are very high risk, but they could also be very high reward. So they serve a similar purpose as the PennantPark Floating Rate Capital, but instead of focusing on run-of-the-mill standard mid-operation companies, they focus on the higher risk companies for potential higher reward. And let's see how that's been doing for them when it compares to the others. It looks like they pay a dividend of 11 cents per share, and their share price is just about $8 even. So $10,000 invested at $8 a share would get us 1,250 shares. Multiplied by 11 cents a share, we would be able to generate $137.50 a month. This is much better than our first stock today. However, we do got to keep in mind that the nature of their business is higher risk, So there is a higher chance that it will not be a stable or steady dividend if something goes wrong in the market, which causes startups to take a hit. Each startup that ends up defaulting on their loan could become a snowball effect. So high risk, high reward. Now we move on to our next stock, which is Ellington Financial, ticker symbol EFC. Now they're kind of a hybrid finance company, and what they do is they invest in mortgages, residential and commercial, as well as consumer loans and real estate-backed securities. So the best way I could describe it is what they were doing in 2008 of buying someone's mortgage. They kind of do that, but it has more government oversight to it now. And for the mortgage-backed securities, for the real estate and the consumer loans, they pretty much just buy your debt. And then whenever you pay debt, they take the interest money and keep it for themselves. So they're very dependent on what the mortgage rates are at and what exactly the interest rates are. Because if interest rates or floating mortgage rates change, that affects your debt, and, well, your debt is their business. So that could adversely hurt their pockets if rates drop. Now, they pay the highest amount so far on the list today at 15 cents per share per month. Their current share price is about $12.50. So $10,000 invested would get us 800 shares. 800 shares times the 15 cents comes out to about $120. So a step down, because the higher share price equals less overall money, less bang for your buck. Your 10,000 doesn't stretch as far. Just because something has a higher payment doesn't mean it's a better investment or that you'll get better returns. And the last stock that we have on our list today, Dynex Capital, ticker symbol DX. Now, what they do is they are a mortgage real estate investment trust, an IMREIT. They primarily invest in mortgage-backed securities, similar to what the last company did. However, they also split their investments into short-term borrowings so that they don't have too much focused on long-term mortgages. They try to mitigate their own risk in a already partially mitigated environment, because thanks to the crash in 2008, the government is backing all these different things now to a point to try and prevent another bubble and crash cycle like that from happening again. Now, they are at the highest spot in today's list for a reason. They pay the highest amount in dividends per share per month at 17 cents a share. Their current share price is $12.75. So our $10,000 investment at $12.75 would get us 784 shares. Multiplied by the 17 cents a share comes out to $133.33 per month in dividends. Now I'm wondering, do you own any of these in your own brokerage accounts? I personally am not invested in any of them. I was invested in the Apple Hospitality REIT early on in my investing career, but I saw that it was not returning very well, and it was just underperforming compared to other things that I was more interested in, like Coca-Cola or Realty Income. But as for the others, they don't really hold any interest for me, except for possibly PennantPark Floating Rate Capital. I have heard good things about that one, so it might actually be worth a bit more research. But the others seem a little too much risk and not enough return for me to be interested in investing in them. But definitely let me know what you think in the comments below. If you think that they're really good and I'm missing something, I'll go ahead and give them a deeper dive and look into them more carefully, and maybe find my new favorite stock that way. Thank you for watching. Don't forget to like, comment, and subscribe. It really helps the channel grow. And these videos do take longer to research, so I would really appreciate if you just go ahead and drop a thumbs up. And as always, I'll catch you on the flip side.